This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Howdy, everybody. Thanks for tuning in. I'm Mike Mansfield. It has been a busy couple of weeks with news and information and data. You know, we're back in World War III, which is a little dramatic. It kind of plays into oil prices going up, which fights inflation. Yet this morning we got great inflation news. So the stock market's in a good mood. Geez Louise, we had the SpaceX thing, which obviously in the last couple of videos we were talking about. That's been a turd burger so far. Thing opens up at $150 a share over a couple of days, works its way up to about $220. Currently trading in the 140s. So we haven't even hit the restricted shares coming on the open market in about 3 weeks from now. So it's going to be pretty fascinating to watch that one play out over the next number of months. But in any case, there's a lot of data, a lot of information. Still believe markets probably going up through the end of the year, looking for your S&P to be around 8,000. But there's a lot of drama between now and then. You know, the war thing is problematic. Midterms are problematic. But let's jump into it. Let's look at some of the data that we're looking at and the things that we're evaluating when we're considering portfolios. I show this to everybody constantly. This is the CME Rate Watch tool. This is what the market uses to project where interest rates are going. So if I go to the July meeting, you see the big blue bar on the left side, almost 90% probability rates stay the same, 12% probability there's a rate increase. In September, same thing, 40% is the left bar that rates stay the same, but now there's a 60% chance that they increase. Fast forward to December, 19% chance rates stay the same. Everything else is that there's an increase. And this is crazy. I personally, I'm sure I can be wrong on this, but I personally wholeheartedly believe the Fed is not raising interest rates. Yet the whole industry, the market, everybody are geared towards the idea that they're going to. Remember, Federal Reserve Warsh comes in. What is the first thing he does? He turns off forward guidance. That way he can stop letting the market front-run rate decisions, which I thought was a great idea. But I think the real reason is he realizes that he wants to adjust the way that they calculate inflation. They want to go to high-frequency inflation versus old-fashioned dinosaur-era surveying of inflation. And when they go to high-frequency inflation, the real-time numbers are going to be lower. This is going to give him a catalyst to cut, I think. We will see what happens. But what am I even talking about? I've touched on this before. Here's Trueflation. This is a private third-party analytics company. They use millions of data points in real time to calculate what immediate term inflation is. If you can look at it on the screen, you see that the big white number in the blue box, 1.92%. So remember, the government just reported inflation. Last month, they came in at 4.2%. This month, they just came in at 3.5%. Much of that's because of the oil prices rolling over. Trueflation, this third-party survey, has it at 1.92, but this is using the model and the structure of what Fed President Warsh is trying to go after, and that is real-time high frequency. Now, I showed this to someone the other day, and they're like, what are you talking about? Inflation's still there, Mike. 1.92 is a great number. It means inflation is stifled. It is down. It is below the Fed's target of 2% at the moment. So that's a net positive. But that doesn't mean the inflation that has been there for the last 4 or 5 years has disappeared. That 30% or whatever that everything has increased is still there. This number is just saying it's not growing as fast. So the feeling of, what are you talking about? How's it only 1.9%? Well, that feeling exists because prices haven't come down. They're still elevated. They're only growing now at 2% instead of growing at 9% or something more dramatic. But still, very different data read than what the government is using in their archaic workflow process. In fact, this number is higher than a week ago, and that's because since the war has ticked back up since last week, oil prices have gone up. So this number has ticked up from about 1.8. So it's starting to recalculate real-time feeds of oil prices coming in. So this is something we're watching. I love this tool. It's extremely valuable. If you go Google and read about how Trueflation works, it tends to front run inflation from the government by a number of months. So it was not a mystery that month over month, the government's version of inflation fell when this number was always lower. So like that. Now, manufacturing, we talk about manufacturing quite a bit because all of a sudden manufacturing is increasing. It's a little softer for June than it was in May and April, but these 3 months are the biggest 3 months that we've had in manufacturing in a long time. Let's just go back a few years. You can kind of see on a longer term chart, manufacturing has been improving. Good golly, I've got it somewhere else. Here's a different version of it. Here's the ISM manufacturing report. And so even though it's kind of hard to see, on the second half of this chart, you see 2025 manufacturing has been just creeping up in general. Anything over a 50 is an increase in manufacturing. Right now, we're running a 54 for June. That means manufacturing is increasing. Why is manufacturing increasing? Well, I think this right here is a huge component of it. U.S. real CAPEX. This is companies spending real money in the United States to build and do things. They do this calculation of real CAPEX against our GDP. You can see the number here in the headline number came in at 15.7%. So that little orange line you see, basically what it's showing is private companies spending money in the United States. And you can see this thing's just getting stronger and stronger right now. So people are really spending money. That is playing into this increase in manufacturing, which is fantastic, which is increasing. Oh my gosh, I'm losing my voice. I'm getting too excited. It's increasing earnings. So holy cow, FactSet, who we use quite a bit because this is the country's largest analytics company that aggregates and does all of the bottom-up testing for earnings. They just put out this report recently where they went through and polled all of the major industry analysts. Now, this is what's amazing about information, right? We all get emotional. We all watch the news. We all go to the gym and talk to our friends, and we go play pickleball and we talk to our friends, and everybody talks about how the end is near. It's all falling apart. Everything feels like a sour pickle. And then you go to some unemotional stuff like this, and industry analysts in aggregate predict the S&P 500 will raise 21% over the next 12 months. The survey was taken when the S&P was at 7,400, and their bottom-up price target by using no emotions but using earnings, data, and information puts the S&P somewhere close to 9,000 in the next 12 months. Now, does that mean this is gospel and that's what's happening? Not at all. All it takes is one nuke flying and this is over. But when you look at math and data and the things I'm talking about unemotionally, it's pretty amazing that the industry feels that there's a lot of upside potential in the markets over the next 12 months. Pretty wild. But also, once again, kind of a net positive. One of the things I was watching some news thing the other day, and someone was giving a lot of criticism about how expensive the S&P 500 is. Well, that is true, but it's not as expensive as we sometimes pretend that it wants to be. So let's go to the all-time chart. So what this chart shows is this is what's called the PE ratio. So this is price divided by earnings. So price divided by earnings helps everybody understand how the market is trading. So even though this chart looks a little crazy, like you see this giant line up right in above 2007. So when the market crashed in 2008, even though the stock market went down, earnings collapsed. And so that's why it became a very expensive market, even with the market going down. But even since then, we can see here that the average of the S&P 500 PE ratio is about a 20. The market's trading at a 25. These kind of free websites stink for this stuff. And it's rolled over lately. It's actually the stock market lately, as it's gone to all-time highs, has actually gotten more affordable. Let me go to a shorter term chart here. Like here's a 1-year chart. So a year ago, the PE ratio was close to a 28. it's come down. It came down to a 24.5. It's up to a 25. But yeah, even though the stock market is at all-time highs, certainly from a year ago, it's actually less expensive mathematically right now than it was a year ago, based on the quality of earnings and revenues that are coming in at the moment. And I think that that is a pretty amazing perspective when all we want to talk about is the emotional. Well, the stock market's really high, therefore it must be bad. The other thing that's happening right now is oil is creeping back up. Here's just the oil, one of the oil ETFs. No big deal. Here, I'll draw on it real quick to make this super fun. So obviously oil was hanging out real low, doing nothing for a long time. And then it skyrockets in February based on World War III. We have a pretty massive pullback. And over the last few days, it's gone back up. It's still well off of its highs dramatically. It still has some ways to go to kind of stabilize to what it was. But all of this equates to us, the end user consumers, into gas prices. And so here's national gas prices. And this is always kind of a funny conundrum to me. So right now, national average gas prices are $3.65 a gallon. They've come off of a peak of $4.33. So they've pulled back pretty well, but they're also coming from a place where they were, $3 or $2.70 or something like that. Once again, if you're in California, none of this applies to you. So stinks to be you. But what's amazing about this is we hear in the headlines, holy guacamole, gas prices are so high, no one can afford it, this is ruining people. But when you look at this chart, we've had $4 gas prices in 2008. We've had high threes through all the mid, 2010 to 2015 kind of stuff. We had those back in the early 2020 time period. We've lived in the $3+ range more in the last 20 years than we haven't. And when you go back to 2008 or you go back to 2010 and you hedge current wages for inflation adjustments, we are mathematically, even at $4 or $3.65, we are mathematically paying way less per internal household revenue than we were back certainly in 2008 for this. And so even though it's a big headline, it's kind of a buzzword. Oh my gosh, gas prices are so high. From a historical context at the moment, they're mathematically relatively low. But still, we live in California, some of us and some of you don't. And, for those Californians, the issue isn't current events. It isn't current gas prices. It's we just had 2 refineries closed. We just lost 17% of our refinery capacity since last December. So our gas prices are permanently elevated. But in any case, like I said, a lot going on. Busy times. Pretty exciting to be here to help people, to talk about all of this stuff. These are the things that we're watching. I expect certainly a lot of volatility as we work our way through the midterms. Certainly some of the current market events that are going on. Earnings are kicking back in right now, so those earnings certainly need to hold up in order to support the market cycle. But we are suspicious that we're going to see a nice push through year end here, at least the way the cake is baking at the moment. So we'll keep updating everybody. If you have any questions, thoughts, concerns, curiosities, please reach out to our office, or certainly give us a call and visit our website, thelindgroup.com. Everyone have a great day.